Let's welcome in our first guest. James Sullivan is Managing Director, Asia Pacific Equity Research at JPMorgan. He's with us on the program. James, great to have you with us here. Appreciate your time on CNBC TV18. I just want to start with whether in the US there is a sense developing, and one is reading and hearing about it more and more, that bullishness is at a bit of a peak level. There are no bears left anymore. The institutional survey, which is widely followed, that was quoted as kind of pointing to euphoric kind of levels. Is that so, James? What's the house view in terms of markets in the US from here out?
Good morning. Thanks for having me on the program, and happy birthday to both the channels and relevant mothers. So hopefully everybody's having a good day. No, look, it's a great question, and I think you're very clearly seeing that in share price action. You're seeing markets go on a year-end rally in the US as well as in many markets here in Asia. The JPM house view is that that rally will continue through year-end. The difficulty that that presents from a 2024 perspective, though, is that you set expectations and the overall bar very high walking into next year. So we do see the potential for some market performance early in the year, very front half loaded. The challenge as we get into the second half is we do see an economic slowdown globally. We do see downside to earnings here in Asia for MSCI Asia Pacific. The street's looking at $51 in EPS estimates. The JPMorgan view is $48. And so not massive downside, but a negative earnings revision cycle. And you are likely to see changing expectations in terms of the potential for rate cuts. The market's priced in 100 basis points of rate cuts in the first half of 2024. JPMorgan house view is that's much, much more likely to be second half biased, with the potential to push into the following year. So you exit this year very strong, very high bar going into 24. Again, some opportunities for strength, particularly off the back of idiosyncratic election timing in the first half of the year in many of our Asian markets, but then a significantly more difficult picture in the second half.
Okay. James, thank you for your wishes, and happy to have you here on CNBC TV18 in a special moment. How are you feeling about a market like India? You know, we were just having this conversation about how if you would have stayed invested for the last many years through thick and thin, you would have created a lot of wealth for yourself. Do you think that continues to be the case in the Indian markets? And what is your advice to retail investors watching you right now?
So, like, overall, JPMorgan is overweight India looking forward into 24. The backdrop for that is a combination of growth, which we've talked about on prior programs, but also recognition that India is running the highest corporate ROE out of any country in Asia right now. And so you're not only seeing growth, but you're seeing extremely high quality and high return growth. And we do expect that that will continue. As you noted earlier in the program, the market index right now has largely been driven by mid and small caps. We do see opportunity in the large cap space, particularly in the financials and some of the consumer names. So we do see the potential for the market continue to roll from here. From a short-term perspective, looking at market positioning is extremely important. In our year-ahead note, we had published the fact that foreign investors were underweight India. As you noted, that is already starting to mitigate, again, setting that high bar as we go into early next year. But from a full year 2024 perspective, we're looking at the Indian index, base case trading around 22,000, bull case trading around 25.
Hi, James, and thanks for your wishes, both personally as well as professionally. Well, what about China? You know, a couple of months ago, it would be logical to see some kind of money move there, some kind of interest coming into China. I'll tell you what, from there, India's widened the gap, and we have outperformed even more. Do you think Chinese markets at some point of time become attractive, or do you think investors would rather stay with earnings growth, with better, stability at the center? Your view?
So we think the China market is attractive right now. There's two ways of looking at it. From a broader macroeconomic perspective, you saw 1 trillion RMB in stimulus in October. The rumor is that we're likely to see another trillion coming out of the PBOC in the months to come. You are looking at an easing environment as we enter into the top of 2024, and the potential for a pickup in overall economic activity, which we're starting to see in a mixed way in some of the high-frequency data points. We think those will strengthen as we look forward into the top of next year. From a bottoms-up perspective, however, it's important to note that there are stocks and sectors that performed extremely well as we looked through 2023. And so one of the core discussions that we're having with investors regionally, but particularly relevant to China, is to some degree, let's ignore the index and let's recognize the fact that China pure EV stocks are up over 50% on a year-to-date basis. elements of the China tech stack, despite the potential for geopolitical tensions, et cetera, are up over 60% on a year-to-date basis. So you've seen a massive dispersion in sector performance in China, which offers significant potential for investor returns if we're doing the bottoms-up work, if we're analyzing company and management level decisions in an era of very significant change.
So, James, you know, the next big trigger for this market, both globally and locally, seems to be the impending rate cuts, right? The expectation is that it will happen in the second half of the calendar year 2024. Is that your base case as well, both for India as well as for the US? What are you penciling in?
So we are looking at the potential for rate cuts in the second half. The view from a JPMorgan perspective is that roughly a 60% chance of a recession as we look forward into the second half of 24, first half of 25. That would give the Fed significant and ample room to look at rate cuts. However, that would result in a downdraft to both global economic activity, which has a significant impact on us here in Asia. Asian markets in general are very linked to global exports, and as well as a downdraft in the potential for consumer spending. And I think the latter is a very important point to make. If you look at the upside surprise in consumption expenditure, particularly in the US, it's segued from excess savings that were built up during the course of the pandemic to really wealth effects on the increases in both real estate as well as the overall equity market in the US. If that starts to roll over, we would see a significant impact on consumption trends, beginning in the US and potentially in some Asian markets as well. So again, bottoms-up work, doing the analysis on sector specifics to understand the relative dispersion trades, both across markets as well as within markets, is absolutely critical as we look into second half of 24 in particular, because we are looking at very high levels of market volatility.
Okay, James Sullivan, as always, thank you for joining us, and especially on a day like today when we have big celebrations, thanks for being a part of our big party here on the Lal Street. Thanks for joining us. Okay.